Housing is just front and center in this inflation story. It was the driver of the economy during the pandemic. And now we're seeing this sharp U-turn. So much to talk about. I want to get right to our guests. Danielle, I want to begin with you because, as Tyler said, we saw the 30-year fix cross over that 6% mark. In fact, mortgage rates are now double what they were at the beginning of this year, going from around 3% to over 6%. So if you are a homeowner right now, have you missed the opportunity, Danielle, to sell at the top of the market?
You know, despite the fact that mortgage rates are up pretty substantially, we're still seeing home prices increase. So when it comes to pricing, you likely have not missed the top of the market as a seller, but we are starting to see on the ground conditions shift. Whereas we had been seeing declines in the number of homes available for sale, we're starting to see increases for two reasons. One, we're seeing more sellers come into the market. And then two, we're seeing buyers grow a little bit choosier. So as a seller right now, it's really important to be tapped into the latest data. You don't want to get ahead of market conditions. The conditions are still tipped in your favor as a seller, but they are shifting. And so you do really want to be tapped into what's going on locally.
Are you surprised at how quickly they're shifting, though? Because I'm actually talking to real estates now. I want to, we go to these open houses on the weekend just to gauge buyer, seller demand, et cetera. And I'm finding that I can't find any open houses right now because a lot of real estate agents are saying, you know what, I'm going to wait a couple of weeks before I do an open because there's so much concern right now about rising mortgage rates and about inflation and about consumers stretching, et cetera. I'm going to wait a couple of weeks. Are you hearing that?
You know, that's interesting. We're not hearing that, but you are correct. You know, at the beginning of May, we saw that the number of homes available for sale was roughly flat against last year. And in the most recent data, it's up by double digits, 11 to 13%. So it is a pretty big change that we've seen in a very short period of time, just 6 weeks or so. And what's interesting is that consumers are navigating these higher mortgage rates and navigating the shift while being mindful of the fact that higher mortgage rates are likely on the horizon still. And so even though costs are up now, they expect costs to go up further. And that's keeping a lot of home shoppers motivated in a time when they might otherwise pull back and wait for the dust to settle.
And for those who are choosing to rent instead, John Burns, I want to get to you. You and I have been watching this single-family rental sector since the Great Recession. It fascinates me. I know it fascinates you. You've been tracking literally $50 billion going into the single-family rental sector. Do you feel like, I mean, I'm seeing names, I just want to quote a couple of these names, Nuveen, Pretium, JP Morgan, Blackstone, Invesco, and JLL. Do you feel like the single-family rental sector is oversubscribed at this point for investors?
Well, there's far more money than there is opportunity, yes. But, you know, they're worried about inflation, and rental housing's in inflation yield, and the Fed's worried about inflation, too. So the money just keeps pouring in. We had a conference yesterday that was oversold on build for rent, so they're still going gangbusters.
Well, and that's an interesting, you talk about build for rent, still a very small sector. We were in Charlotte, North Carolina last week with American Homes for Rent looking at, they were opening a community over 200 homes. And I was talking to some of the renters. These are I was surprised, very high-end renters, people who could afford to buy a home, but were choosing to rent. You know, if you're advising somebody, whether they're buying, selling, choosing to rent, if you have the wherewithal to buy, do you think doing a single-family rental home is really great for their financial wherewithal to do that? Or are you losing that equity that you could be gaining in a home?
So people just don't get it, Diana. So there's people that want to live in a house and want to be homeowners, but just don't want to own right now. I just moved to Charlotte, or we might get married, or we might want to move in 4 years, and I make a lot of money, and that's the 12% or so of households that rent single-family homes that we're talking about. There is another segment that's stuck in very low income, but the investors that we're working with and the ones you're talking about are not down in the $1,000 a month rent range. They're up in the $1,700, $1,800 a month rent range with clients that or tenants that make $100,000 or more per year.
And that's why we're seeing the build for rent going gangbusters, because a lot of these people want to live in new build. They want to live in 3- and 4-bedroom houses, and that's what we were seeing there. I was seeing Porsches in the driveway of some of these rental homes. Where do you see rents going? I mean, we just saw a report on apartment rents crossing the average $2,000 a month mark. Where do you see rents going?
So think about what the Fed's doing. They're raising mortgage rates, which is going to kill the for sale market. So what's that going to do? it's going to increase rental demand. So we're seeing rents continue to grow. It's adding to this investor thesis about rents. I think at some point here, the Fed is basically telegraphed they're going to induce a recession. You just talked about how strong the consumer is. It's going to take a lot to induce that recession, and you're not going to see rents come down significantly or even rent growth slow dramatically until people start losing their jobs or are worried about losing their job.
So Danielle, where does that leave that first-time home buyer who, is paying so much in rent right now that they can't afford to save for the down payment? How do you advise them?
Yeah, it's hard to save when rents are going up everywhere. But housing is the biggest portion of most families' monthly budget. So if you can find a way to cut back on your housing budget, that does enable you to save for the future, including for things like a home purchase. But certainly the market's not going to be easy. On that whole buy versus rent decision, I think it's also worth considering that with rents going up, even though housing costs are going up, it can make sense to lock in that mortgage rate and lock in that monthly housing cost. You're not subject to the whims of inflation once you've got that fixed rate mortgage. And that can be really beneficial for a lot of households. As their incomes go up in the future, they can put that over into savings instead of into trying to figure out how to pay those monthly rent increases.
But Danielle, what about the mortgage market itself now? It's been pretty tight since the start of the pandemic. Obviously, it tightened after the Great Recession, but then it tightened again. And if you look at the Mortgage Bankers Association in their monthly chart of mortgage credit availability, it's actually very low. Do you see it starting to loosen up? As we see mortgage demand is literally half now of what it was a year ago. A lot of that's refinance drop off, of course, but it's fewer home sales. Do you see mortgage credit loosening up a little bit, or is it still going to be pretty tight going forward for those borrowers?
I think as long as those recession concerns remain front and center for the industry, I think that's going to lead them to be a bit cautious. At the same time, with refinance demand drying up, that's going to give them some room to be a little bit better at servicing the purchase market. So you've got these competing forces. It's tough to see which one wins out, but I don't think we're going to see a lot of change either way. But the one plus of that relatively tighter credit conditions is that homeowner equity as a share of household real estate value is at almost a 40-year high, nearly 70%. So when it comes to the financial position of homeowners in the aggregate, housing is on really solid footing right now.
So do you think for some people that pulling equity out of the house right now is a good idea, given that we're seeing so much higher costs for literally everything we need to buy?
I think tapping homeowner equity for investment purposes can be a good idea if you're making improvements, if you're investing in education, perhaps starting a small business. But it's important to remember that if you tap that equity, you've got to pay it back at some point. So if you're tapping it for investment purposes, that makes a lot of sense. For consumption, I think I'd caution against that.
And you'd probably want to do it on a HELOC because most people have a rate now below 3% on the 30-year fix, and they're definitely not going to want to lose that. John, if you wanted to diversify, if you're looking, real estate has always been a great diversification for a portfolio, and a lot of people, we talk about the big institutional investors going into single-family renters, but what about folks who want to use one of these, online platforms where you can buy a couple of rental homes where they do all the work for you, they manage it, they get you the deal done? Do you think now is a good time, or is the market just too overheated for people who might say want to either use their home equity to get into another investment, buy a couple of rental homes, or if they're just afraid of the stock market right now and want to be somewhere else?
Well, I mean, if you're doing your homework, I think the long term you should have an investment in housing, and rental income is a good diversification play, and it was really only available to institutional investors. Now there's lots of platforms where mom and pop can invest in rental homes sight unseen, or in portfolios of REITs. You can go into Blackstone's B-REIT and get some cash flow from real estate that way. So I do think that's a wise move over the long run.
Any red flags there, though?
Well, I say, yeah, there are some kind of startup companies that don't really seem like they're doing all their homework and could be buying homes and outbidding others. And so, pick your professional management company carefully would be my caution.
What about, let's move into the commercial market a little bit. I mean, we've been looking at perhaps getting into, some people wanting to get into REIT stocks, as you said, in single family, but maybe they want to get into other potential investments. If you were looking at the commercial sector right now with inflation, et cetera, do you want to go into a sector like retail that's already so beaten down that you can get it on the cheap, or do you want to go into, something more solid, which would be industrial or apartments, obviously very good right now as well, or hospitality, which is coming back?
So industrial is starting to roll over, by the way. So that's part of the reason why so much money is coming into rental housing, is that all the other real estate allocations are bad investments. Retail really hasn't adjusted very much in price, and neither has office buildings yet. It's just the lenders have done a lot of what we call extend and pretend and pushed the problems out for years. I do think once some distressed investment opportunities are available, you'll see money transfer out of housing cash flows and more into other commercial real estate.
And are there any particular sectors that you think we should, retail obviously hasn't, as you said, adjusted as much as it needs to. Is there something that we don't know about, some gem in the rough there?
Not really. People are looking at manufactured housing, but that's, now they're getting hammered for raising rents on those people. People have been calling this an everything bubble. I think that is the right way to classify it, and cash flow with housing seems to be the right place right now. Even if you think home prices are going to decline a little bit.
Well, and I asked Danielle this, but I want to get into this more. John, I'll get from you. Do you believe that home prices, that the gains will simply shrink? We're seeing 20% home price appreciation year over year now, which is clearly unsustainable in this type of market. But do you think that home prices nationally will actually go negative, actually fall? We only saw that during the Great Recession and during the Great Depression.
Well, we are forecasting that for next year, but we're also in the recession camp. The question really is, where is the supply? They're killing demand, right? Where's the supply going to come from? And it's not going to come from the resale market. Resale supply needs to triple just to get back to normal. It's going to come from the new home market when the home builders build a lot of new homes that are empty that they need to sell. Right now, none of them are finished. But if you look at Austin and Boise, 35% of the purchase volume in those two markets is new homes. So those are our two highest risk markets. Most of Texas right now, actually, it's the complete opposite of the national story. They are building more homes in Texas than ever before. San Antonio, Austin, Houston, Dallas, Fort Worth. I think that's where the supply is going to come from, and that's where we're concerned. But those homes aren't going to be finished this year. This is a next year story.
But we are seeing supply rise.
It depends how healthy the economy is.
Yeah, we're seeing supply rise for the builders.
From like nothing to a little more than nothing.
Yeah.
And I would add to that.
Yes,
I would just say a lot of that supply is still under construction. And so, like John said, it's coming, but it's not actually completed and on the market right now. And so it's not really comparable to the supply that you see on the existing side of the market.
So let me ask you, Danielle, do you expect to see home prices go negative on a national basis, or just in certain overheated markets, or just see those price gains shrink?
So we absolutely do expect to see price gains shrink. It's unexpected and a little counterintuitive. We just released a revised forecast where we've raised up our price forecast for 2022 because we've already seen prices maintain a lot of momentum so far this year. But we do expect the trend to slow as we move throughout the year. We're starting to see existing home inventories grow, just like we are on the new inventory side, because demand is really being hampered and because we're starting to see some more sellers, as I mentioned. Moving into next year, I think a lot depends on what happens to broader economic conditions. And if the economy were to slow significantly, then we could potentially see home price dips. But that's not my base case. My expectation is that we'll see home price grow. We've got a lot of undersupply nationwide. And so I don't think we're going to see big declines nationwide.
I talk to the builders. You look at the builders' earnings reports, and the CEOs continue to say, we have great pricing power, despite what you're hearing about mortgage rates and despite all this. And they're, of course, pointing to their increased costs for land, labor, materials, and all the construction issues that they've been having and how that's adding to their costs, that they have to raise prices. They can't build lower-priced homes, which are the ones that we really need to see. So, Danielle, given that scenario, of builders continuing to raise prices. Can they do that, or are they, do you think, perhaps going to have to get back into the more affordable category?
In order to continue to build, I think they're going to have to really explore that more affordable category. But they've got a lot of supply in the pipeline already. So I think their first focus is going to be on making sure that they can sell off that existing pipeline and then get creative as we move into the future. And it's still going to be challenging to build at that lower price category because it's just harder to have the same margins. But that is certainly an area of opportunity for them.
So, John, would you get into the home builder stocks right now? They're cheap.
Well, the home builders are buying their own stocks, so that'll tell you what they think about it. I actually disagree with what you just said. It was true a couple of weeks ago. The pricing power is gone. So they went from 2 months ago, 92% of them were raising price, to last month, 35%. This month,
so I haven't gotten those earnings reports yet, though. I'm going from the last quarter, and things are changing that fast.
Well, we went from 3% to 6% mortgage rates. I mean, mortgage rates just went from 5 to 6 in the last 2 weeks. So, I mean, trying to stay on top of this is hard. And when this all happened, the demand so far exceeded supply that, yes, they still had pricing power because as demand was coming down, it was still higher than supply. And their costs were going up. I do think what's going to change for their benefit is that the costs are going to flatten and even start coming down. And you know, Richard McPhail, who was just on from Home Depot, knows this better than anybody with the volatility in lumber prices. And I think there's so much ordering going on in the system for the last 2 years that those orders are going to catch up. And then if they start building a few less homes, the costs will come down, which should be good for their earnings.
Well, as you talk about how things are moving so incredibly quickly, I'm going to ask both of you this. John, I'll ask you first. What is, do you think, the most important indicator in the housing market to watch? Because the home prices are 2 months backdated. The sales are 1 month backdated. The earnings are, of course, a quarter backdated. The only thing I would say is that I like the weekly mortgage applications just because at least I know what happened last week. What do you watch, John?
Yeah, so the mortgage applications is good. It's days on market or months of supply, which you can update daily. And everybody uses a different denominator for that, but I would watch that. That's the demand-supply balance in your local market is how many people are out there buying versus how many people are selling, and that's what will determine price. And it's still, demand still extremely exceeds supply there.
Danielle, are you watching the same?
You know, we have our weekly data, but I think you're right. High frequency is what you want to watch for. I look at the new listings measure that tells us how many home sellers are coming onto the market, and then the balance of active inventory. When buyers are really active, that active inventory stays low. But when we've got sellers coming on and buyers pulling back a little bit, we see that active inventory growing. That's what we're seeing right now, and that's been pretty good at telegraphing changes in the market.
I heard something really interesting yesterday. Obviously, we got the news from both Compass and Redfin that they were laying off workers. And Glenn Kelman, the CEO of Redfin, posted on the website this very long post about why he was doing what he had to do. He said he expected to see home sales drop, not just for months, but potentially for years. And then I got him on the phone after that, and he threw out something interesting. He said, well, the one area that we are seeing a lot more demand very suddenly in is our iBuyer program. And obviously, that's the one where these companies will come in and they'll buy your home all cash, as is. It's going to be a little bit less than you might have been able to get on the open market, but you don't have to do anything. You just sell it direct without the hassle. I'm trying to find out from other iBuyers if they're seeing the same. That's what Kelman said. Do you expect to see that iBuyer trade, these companies that are getting in there and helping homeowners because of this potentially desperate homeowner situation, John?
Well, first you got to ask, who's selling a house, and are they going to give up their 3% mortgage and go give us 6 somewhere? So I don't think there's too many of those. But when you're selling a home, your biggest concern is you're going to get into escrow with somebody and they're not going to be able to qualify for a mortgage, which is a massive concern right now. And the iBuyers are all cash. So it doesn't surprise me. And the other thing is, they serve a need there. It's only maybe 10% of people who would ever consider this. But the seller will not have to worry about owning 2 homes at a time if they're actually moving, or having to move out and rent for a while their new home is being finished. It was interesting that he said that, and I believe it, but it's still just a small part of the market. The more interesting thing, I think, is I'll give you go back to the landlords. I think the landlords are the ones that are getting calls, would you buy this house?
Interesting. And Danielle, do you expect to see more iBuyer demand?
Yeah, I agree with John that it's a niche market and that it is a useful comparison point for a lot of potential sellers. They can be particularly useful if someone is selling a home that they don't live in. But I think for a lot of owner occupants, it's generally not the avenue of choice when it comes to selling. But there are a lot of different ways to sell your home right now. And so that innovation, I think, is useful for potential sellers to know about. The options are just much more than they used to be.